All right, hello, beautiful people. Welcome to another segment of Money Talks. We are very excited to present Brown Advisory Group to you today. We have used their sustainable growth portfolio, their SMA, with a few of our clients, and we've had great success with the Brown sustainable growth strategy. They also have other strategies available as well. As you know, as your advisor, we're always looking to educate our clients and give you more information, just to make you, a more aware client. Okay. So today, Katherine, actually, I'm going to hand it over to Jake, and he's going to introduce our speakers for today. But our guest speaker is going to talk a little bit about Brown's philosophy, and she's going to get into, I don't know exactly everything she's going to talk about, but some of the key stuff will be centered around Brown's philosophy and the portfolios, their methodology and how they manage money. And perhaps she will provide us with their outlook for the balance of 2021, okay? So with that, I'm going to hand off to Jake Flesher. You guys are all aware of Jake. You've met him. He's been attending our monthly podcast for the last 3 or 4 months. So with that, I'm going to go ahead and pass off to you, Jake.
Sounds good. Thank you very much, Rod. I appreciate it. And first off, thank you all to everybody joining today and taking time out of your Friday afternoon. As Rod mentioned, I think this is our 4th webinar, so I certainly hope that you found all of them very educational. We do have a fantastic webinar lined up for you today. One of the things that I've noticed since being in the industry, I've been with Raymond James Financial for roughly about 5 years, but certainly in my position, I've seen an explosion of interest when it comes to ESG investing, especially over the last sort of 2 to 3 years. So I'm really glad that we've got Brown Advisory on the line today, because they do a fantastic job when it comes to ESG stock picking. We've had a relationship with Brown going back to 2013. Our due diligence team is very, very comfortable with their investment philosophy and what they do. But more recently, we added their sustainable strategy in 2020. So first off, Katherine, Stephanie, thank you very much for joining today. I think what the game plan for today's webinar, we have Katherine Kroll, who is the client portfolio manager for Brown Advisory. She's going to provide a kind of a high-level intro of Brown Advisory, and then kind of talk about ESG investing in general, kind of break that down, what it means. It's certainly evolved over the years, so that would be very interesting to hear. And then she's going to talk about a strategy for about 5 or 10 minutes. But most importantly, this is your webinar. Any questions you have, if you look on your screen, you will see a Q&A box. Click on that, submit the questions as they come through. I'll certainly address them to Katherine and Stephanie. So again, thank you all very much for your time. And with that said, Katherine, the floor is yours.
Great, thanks, Jake. And just for the record, I'm happy to turn on my video, but it says that the host has disabled it. So we'll just...
okay. I just changed that, so you should be good to go, Katherine.
Okay, great. There we go.
There we go.
Well, thanks so much for having us. We're really happy to be here. And my background is in ESG. So this is a topic that I'm personally really compelled by, and that the firm has a pretty deep history in. But before we get into that, I'm happy to just give a little bit of background on Brown Advisory for those who are less familiar with the firm. So Brown Advisory was founded quite some time ago now. It's unofficially based in Baltimore, where we led a independent buyout from what was then Alex Brown, and we've remained employee owned ever since. So I'd say if you can take one thing away from our history, it's really our employee ownership, where 100% of employees own equity in the firm, and we intend to remain private for the duration of our existence. And I think that is really critical in ensuring that we're all on the same page. There's a lot that you can find in similarity across our equity strategies. We run a number of equity and fixed income products on the institutional side of our business, which makes up about half of our overall AUM. And then we have a private client side of our business as well. Stephanie and I sit on the institutional side where, like I mentioned, there are a number of equity and fixed income products. On the equity side, you'll find a lot of things that are in common and tie it all together, largely a quality bias, bottom-up, fundamental, stock picking, and really just an emphasis on quality research. We don't think there's an easy place to find all of the information we need to see in order to make decisions that we have a lot of conviction in. And so when it comes down to is the team. And for the last, let's call it 15 years, there's been a focus across the firm on sustainable investing, which is our buzzword of choice. People call it a lot of different things. And I think that's part of the challenge and the opportunity is that ESG, and maybe some of you have heard this many times, but it's worth saying again, it means different things to different people. It will always be part art and part science. So environmental social governance research is research that broadly is considered to be value-added research that can be integrated into the fundamental research process and have a number of outcomes and impacts. But the reasons why folks integrate ESG research and their intention and their methodology varies a lot. It varied when the strategy was incepted over 11 years ago, the strategy Large Cap Sustainable Growth, which Rod and Jake talked about a bit. And it certainly varies now today where we've seen just an absolute boom in this space where new mutual funds are tagged as ESG really every week. And so with that comes the need to find some amount of standardization or at least floor for clients and other stakeholders to be able to discern the very different terminologies and processes that take place. At Brown Advisory and Large Cap Sustainable Growth being our flagship ESG or sustainable investing strategy, it was started because we believed that it could help performance. That's kind of our full stop on why we do ESG research. And you have to remember, this is a few years ago before greenwashing was a concern, where now folks want ESG so badly that they're willing to market it even if it's not there. This was in a time when adding ESG to or sustainable to the name of the fund could create some back and forth on whether or not you can have performance. And, fast forward, we now know that this strategy has largely outperformed in part because of ESG, not in spite of it. But back then it was really important that for our firm, we approached it with authenticity and in a way that was true to how we conducted our research across the entire platform, which was, again, bottom-up fundamental stock picking, which is the same way we conduct our ESG research. And so our sustainable investing journey really started with the acquisition of Winslow Asset Management, one of the oldest ESG shops in the United States. With it, we got Karina Funk's talent. Karina is the co-portfolio manager of Large Cap Sustainable Growth. And she and her partner, David Powell, although they have different backgrounds, really landed on what I think remains to be the bedrock of our approach to ESG. So David was the firm's industrials analyst prior to being the portfolio manager on Large Cap Sustainable Growth. Karina, before she was acquired and at Winslow, was actually an environmental engineer. And what she found on the plant floors of the companies that David was looking at from behind his desk at Brown Advisory was that companies who paid attention to things that just resonate with common sense, better, cheaper, cleaner, greener, those tended to be the companies that outperformed. So not only was it avoiding risks, which I think is typically how ESG is thought of, right? Let's screen out broad sectors of the economy to keep out the bad guys, whoever the bad guys are to the person you're speaking to, but really this emphasis on using ESG to play offense as a competitive advantage. And we call that Sustainable Business Advantage, or SBA. And I apologize for adding another acronym to this over-acronymed space, but it's a specific way of conducting research that kept us really focused in the beginning when there weren't as many stakeholders or as much interest in ESG, and it's kept us focused as the space has evolved and grown to have a lot of noise, frankly, which some of it is helpful and some of it isn't. So being able to focus squarely on good companies with strong fundamentals that are using sustainability or SBA to get even better, either through growing their revenue, having cost improvements, or enhanced franchise value. And I'll get a little bit more into all of those drivers, but that's how we identify ESG, recognizing it can mean different things to different people and is really on a spectrum. We're not just looking for companies only with fundamentals, and we're not trying to save the world through ESG, although we know outcomes can vary. We are looking at that intersection of fundamentals and what we call SBA. And I think when you look at the strategy today and our platform more broadly, that's really stayed true. So we have just under 13 billion in assets under management in large cap sustainable growth. The diversification of those clients is so telling to me. And I'm looking at you, Steph. I'm sure you know this even better than I do, working so closely with our clients, but a number of them use us just as a large cap growth placement, which we think is exactly where we want to be. A lot use us for a sustainability allocation. Some use our usage just to get exposure to the US, and all of that is fine, because when it comes down to it, our objective is to use ESG to outperform. And I really think that the portfolio managers on this strategy and their emphasis on SBA is what has allowed us to build this out across our entire platform to include fixed income products and other market cap and class products as well. So that's a little bit on how we got here. I'll just spend a few minutes going into the nitty-gritty of the strategy, but always excited to talk more about ESG because I know it has a number of different parts and pieces to it that bring it to life. But when we think about the strategy, a lot's already been said, right? So Brown Advisory is always looking for strong fundamentals. We're relying on our team to find a number of things that we think help companies outperform, especially for this strategy. You know, we're looking for things like highly visible revenue, competitive moats, strong economics, really proven management teams. I don't think that's necessarily differentiated, but it comes down for us as the very best business models that are mission critical to their customers, and that should they disappear tomorrow, would feel a lot of pain. And the way we help uncover that is by not just looking at some of the characteristics I rattled off, but also pairing them with the sustainable business advantage. So companies whose products or services are helping to solve for a really thorny environmental or social challenge. Think financial inclusion, climate change, diversity, equity, and inclusion. I think Chegg is a name in our portfolio that we got into recently, which is a good example of that. That's really disrupting the traditional education space and creating a level playing field by providing both online and textbook services that create a more even playing field in terms of the financial barriers that many students face. The other category that helps us uncover SBA is the cost improvement. So that goes back to Karina and David, I think in their backgrounds, Karina just noticing that the semiconductors that she was evaluating on the floor and that David was looking at from behind his desk that used less water, that used less energy, that were leaner, they had better margins. And that was something that was compelling. So that's another way we find SBA. And then the third is enhanced franchise value, probably the most intangible, but still as compelling, and is usually paired with one of the other two drivers. This you can think of as a Starbucks, who, not a perfect company, we don't need them to be perfect in terms of ESG characteristics, no company is, but that's built its legacy and its entire business on this foundation of ethically sourced coffee and sustainably sourced coffee, meaning should a natural disaster occur, and as we see those increase in cadence, it's likely to affect many of its peers' supply chains. But because it's such a resilient supply chain, that's a place where we can have extra conviction in the name. And on top of that, they're also treating their employees in a way that resonates with the demographic of their customers. So those are the three drivers. They help us find out, does this company have an SBA? We need to see that in every company we invest in. We need the strong fundamentals. And then the last piece that ties it together is compelling valuation. So we try not to overpay for the companies we invest in. 9 times out of 10, we'll find the strong fundamentals, we'll find the SBA, but the valuation just isn't there. And so it means we either have to be really patient or really nimble. And I think 2020 was a year where, typically this is a portfolio that has very low turnover. We want to hold these names for a long time. We're highly concentrated. And so we want to be, completely sure of the name. And it does mean that the pricing is one where we need to pay attention and have our ready to buy list, because we think the best sell discipline is to have that list ready to go. And in 2020, we got a shot at a number of names that have really helped to upgrade the portfolio. So we are a one in, one out philosophy. You can think of it as Darwinian capitalism. And it really makes us have honest conversations with our team that all comes together on a regular cadence. And going back to our shared ownership structure, there's this equally vested weight in making sure that we're making smart decisions that ultimately Karina and David have the final say on. So all of that, I think, comes together and brings the strategy to where it's at today. Obviously, there's no crystal ball, but I'd say if you look at past track record, the strategy performs best in markets that are volatile, that are disrupted. Its downside protection is in the 6% of its peer ranking. So it keeps up with the market when it's strong, but it's really in that downside protection where it adds a lot of its differentiation. And in part, that's because of the SBA piece. And I'd also say it's how the portfolio managers look at growth. So we own the Microsofts, we own the Alphabets, but we also own names like Ecolab, for example, that post more of those low double-digit growth rates, which won't necessarily keep up with the high octane growers, but in periods where the market is dislocated, it really helps provide that downside capture. So I want to make sure we have time for questions. I talked a little bit about an example of names in the portfolio, but let me pause there, see if there's any questions, and if not, maybe we can just get into a name or two, if that would be helpful for folks.
Hey, Katherine, it doesn't look like any questions has come through, but I'll fire one away. One of the things that I find interesting about Brown is, when you think about large cap growth companies within the US, what comes to mind is typically, Facebook, Amazon, Google, Netflix. I've been seeing how you guys have been doing. Not only have you been keeping up with the market, you've actually been outperforming the market, and you have really little exposure to those big names. Can you talk to me why you don't own them, really?
Yeah, it's a great question, Jake, and thanks for noticing the performance. I think in 2020, this became very clear where 40% of our benchmark were just 8 names. We had exposure to 2 of them. And so it really means that our active share is important to us. We think to beat the benchmark, we need to look different than it. And for one reason or another, we just can't get excited about names like Netflix, where we don't find an SBA, or names like Facebook, where there's a previous ownership history, but we think there are better options on the table. I mean, I think looking at Apple is a really good example where, there will be months where Apple alone will be the reason for underperformance. But the name that we bought into in place of Apple, having owned it in the past and just not being excited about its growth profile, is American Tower. And it's not a super well-known name, maybe not as widely clung to as some of the tech names, but it's been able to, in the long run, really add to outperformance, again, because of that downside capture. So I think it boils down to the way we look at growth, the way we integrate ESG, and the basic belief that, again, to beat the benchmark, we have to look a bit different than it.
Sounds good. We did have one question that just popped through, Katherine. Are all companies eligible for the portfolio as long as their SBA outweighs any ESG negatives a particular company might have?
Such a good question, and thank you for asking it. So we perform two assessments: ESG risk assessments, which, as I mentioned earlier, I think are a bit more traditional in nature when you think about the ESG industry and where the majority of the focus lives. And this means we look at 30 different factors to understand how is a company managing their basic risk profile. Increasingly in 2021, we think that's table stakes, especially among large cap companies. But we won't invest in a company if the risks are too big. So for example, Facebook is a company that we owned in the past. As I mentioned, the SBA was intact, but the risks became too big, and so we sold the name. We tend to find that identifying SBA is much harder than finding companies that manage their risks. So I think the question is spot on in that the SBA is more important than the ESG risk mitigation, but we won't own a name with really glaring ESG risks either.
Okay, sounds good. So that looks like we've answered all the questions so far, Katherine. I know you mentioned earlier that you wanted to touch on a few other names as well.
Yeah, I think sometimes it can be helpful just to run through a portfolio name to show how SBA fundamentals and valuation can come into play. So I mentioned Chegg as a name that hits on the revenue growth of really helping to increase social inclusion within education. Etsy is another name in our portfolio that we started looking seriously at thanks to our shared research team that works up and down market caps. And Etsy, especially then, and I think, among international audiences still, wasn't quite yet a household name. It's really known, for those who maybe aren't familiar with it, as the anti-Amazon, specializing in e-commerce that puts an emphasis on home crafted goods. So the majority of their sellers are diverse individuals, business owners, sometimes of one. So really, really small companies that provide maybe a niche product or service. And what we liked about Etsy right away was the fundamentals. That's something we had a lot of comfort with. We thought it was a company that had a compelling growth rate, that they were just starting to really penetrate their market. There was a lot of low-hanging fruit in terms of operational efficiencies that were in the pipeline. They had just brought on a new CEO that we respected his vision, and he's really went on to bring it to fruition. But we couldn't quite figure out if the SBA was sound. So we went through the ESG risks, going back to the question that I think Joseph asked. We were able to, check the box, so to speak, on all of the risk mitigation, nothing glaring, no controversies, no egregious governance history, no mistreatment of resources. But when we were looking at the operations of the business, we weren't sure that it necessarily could meet the criteria. And so we went into the conversation with management thinking that the potential for SBA was more in the cost improvements than in revenue growth or enhanced franchise value. But we left the conversation with management, and Etsy's done a really good job at improving their disclosure since we invested in it. So there's more data that backs this up now than at the time of initiation. But we learned from Etsy that they had been experiencing a real problem with their conversion rate. So what they found was that their customers, and I laugh because I think I've been guilty of this as well, would put a number of their products into the shopping cart and then fall short in actually pulling trigger on that transaction. But when they started adding sustainability descriptions to some of these products, and actually when they decided to go carbon free, they were the first e-commerce company to offset their shipping emissions. That's when they saw the conversion rate absolutely spike. And since then, they've done a number of studies that show that over 90% of their customers care about sustainability. And that was our launching off point to understand that enhanced franchise value was a real differentiation point for Etsy. They also do a fantastic job at optimizing efficiencies via the cloud. And so their data footprint is just smaller than many other utilizers of data of their size. And they're also helping to host a number of small business owners that, absent of Etsy, probably wouldn't have a home for their small and growing business, which is often a large part of their income. So we put that all together and we're able to find a compelling SBA and get in at a really great price point. Since then, the name has done especially well for us. And even in this year, we've seen that, but certainly in 2020 with the pandemic creating a need for masks and Etsy being able to provide that service.
Question for you, Katherine, and in reference to regarding the sustainable growth portfolio. What's your manager's sell discipline with that particular portfolio?
So we're one in, one out. And that goes back to, I think I mentioned this Darwinian capitalism idea where we have to like the names that we're putting in better than whatever is already existent. And 9 times out of 10, you'll see that come out from our bottom weighted names. We express our conviction via weight. We have a 5% cap on each name, just because the strategy is very concentrated at about 33 positions. But it requires, I'd say we get asked very often, Rod, is it hard to find names in this market where everything's so expensive? I'd say more difficult is finding names that we like more than the names that are already in the portfolio. But the short answer is it's one in, one out.
One in, one out. Okay. I was looking at your current top 5 holdings. As of the first quarter, they were Microsoft, Google, United Health, Visa, and Amazon. Are those still the top 5 currently?
No, I think they've bounced around a bit, but I think those top 3 are still in there: Microsoft, okay, Alphabet, and Amazon. You brought up United Health. I think that's somewhat differentiated for the strategy. It goes back to how we look at growth and the need to find mission critical companies for their customers. We have a pretty significant overweight in healthcare names. So a number of them contribute heavily to the portfolio, and it's typically in that life science tools and diagnostic space, just because we've found companies that fit our characteristics. But otherwise, I think our attribution is mostly aligned, with the exception of healthcare, where we've been overweight pre-pandemic, in pandemic, whatever phase we're in right now as well. And we're underweight in communication services. And that's mostly because of Facebook and our 5% cap on Alphabet.
Gotcha. Okay. And what's your analyst outlook for the balance of 2021? It's been an interesting summer, to say the least. With the Delta variant, and I know you look more, I would imagine, at the long term versus the short term, but just from the perspective of what's going on with COVID, and how do you see the economy, the year finishing out?
Yeah, the unsatisfying answer is David and Karina and the team are just so obsessed with the long-term horizon of the performance of the individual companies, staying really focused on business models. And I think that perhaps one of the most important characteristics our team looks at is, can this perform regardless of what's happening? A pandemic, an election, whatever is occurring in the market today. The probably more satisfying answer, and you have to take it with a grain of salt, is we think that in the long term, these quality growth companies outperform, that good business models outperform. And what we saw in the first quarter with the rotation to value, that might happen again. Maybe the numbers in Delta continue to tick up. I hope not, for many reasons, but should that occur, we think that the portfolio is really well positioned, with a number of the holdings helping to solve for the challenges that the pandemic posed to many people and to the economy. So regardless of what happens in the remainder of the year, we think we're hopefully positioned to continue to outperform. We're up year to date. Should there be a big swing back to value? Yeah, well, we might underperform. We did in the first quarter, but we think in the long term, we are really excited about the opportunities for the really high quality names we've invested in. So we're betting on strong business models winning overall.
Who are your top? I'm just curious. Who are your top EV picks, and what's your position on solar?
Yeah, so it's such an interesting question because the team recently initiated in Enphase. And so Enphase is a solar company, but it's more on the inverter side. In the past, we've had zero exposure to energy of any kind. I mentioned, our sell discipline is one in, one out. We'll get out of a name if we find a name we like better, or if we make a mistake. And luckily, the mistakes have gone down over the years. But an early mistake was First Solar. And so the team's been, shy to revisit that, given how much energy in general, including renewable energy, can vary and fluctuate, going back to things that are not in our control. We like companies that have control over their own destiny. But Enphase is a company that we like for that reason. We think that what they're able to do from a storage perspective, a battery perspective, it goes far beyond the need to, put solar on my roof or your roof. It has a very broad use case. And I think that is what drives a lot of the decisions around our investment decision in renewable or elsewhere. I mean, NVIDIA is a name that we got into this year at a really compelling price point. Not a new name by any stretch of the imagination, but one that it took its diversification away from gaming and into AI for us to get comfortable with. So I'd say when we're talking about those types of companies, we need to see it. There are reasons outside of our conviction around renewable and a low carbon economy that we don't invest in Tesla. That's more on the fundamental side, but we're really cautious about making sure that we're investing in names that have broad use cases and are mission critical regardless of what's going on.
Excellent. So Jake, any other questions come through so far?
Nothing so far, Rod. Nope.
Okay. All right. So let's see here. Let's give Stephanie. Stephanie's also on the podcast today. Stephanie, what's your role? Maybe you can tell our clients your role with Brown.
Yeah, happy to do so. And thank you all for having us today. My role at Brown Advisory, I'm on the institutional sales and service team. So I service you all, I service Rod. I work with Jake very closely in our relationship with Raymond James, which we are very, very fortunate to have, and continue to build this partnership with you all, and hopefully get the opportunity to speak with you more often and be here more often.
I'm tongue-tied right now. Good stuff, guys. I mean, we have been really pleased with the performance of Brown. We're starting to present Brown more and more to our clients as that growth sleeve to their portfolio. The reviews have been rave. Thus far, you have some raving fans over here with a handful of our clients, and we certainly anticipate that we will be introducing Brown to more of our clients going forward. So the group is a little quiet today. I'm surprised that we're not getting more questions coming through. So before we call it end this, Katherine, is there anything else you would like to add that you feel would be important for our clients to know about Brown?
I think going back to the original prompt around, what is sustainable investing and how has Brown Advisory adopted it, there are so many different ways to define this space. I think it will probably get louder before it gets easier to navigate. And so that's why process and team is so important to us. And I think really any manager that receives due diligence. It's ensuring that there's a team that's on the same page, whose interests are aligned, which we hope to achieve through our private ownership structure. And that's pursuing something with a clear objective that understands its why. And for us, it's outperformance. We think ESG, when applied in a pretty specific way, can help with long-term outperformance. And we're excited with the faith our clients have put in us really in the last few years as we've seen assets grow, and look forward to continuing to hopefully achieve the performance that they deserve.
Well, you certainly did outperform last year. Yeah, I mean, it was pretty spectacular, actually. We're not going to hold that to you, obviously, each year, but boy, I tell you, we were very impressed with your performance last year and to date this year. Yeah. So if we don't have any other questions, Jake, do you want to close us out?
It looks like we do actually have one, Rod, that came through last minute. Katherine, the portfolio, see, I got it off of you, Rod. The portfolio seems heavily focused on healthcare outside of tech. Can you discuss how Brown looks at healthcare from an ESG perspective?
Sure, yeah, and that's right. We're heavier in healthcare than the benchmark is. I think we have a differentiated view on healthcare. So you won't see any pharmaceutical companies or companies that, again, don't have control over their destiny, that are subjected to regulation or pricing pressure. We think that visibility into revenue is really important. And so that's narrowed down the types of companies we invest in just from the fundamental side. So that leaves companies that are usually in that life science tools and diagnostic space up for grabs. I think we would have a really hard time on the ESG front finding pharmaceutical companies that we have conviction in, but the fundamentals are step one. And so that narrows the universe before we start. When we look at it from an ESG use case, we're looking at the same type of basic 30 risks, as I mentioned earlier. And then the majority of our SBA theses when it comes to our healthcare companies are around improving life quality and overall performance on medical innovation. So whether it's Thermo Fisher, who recently has been a real contributor in the fight against the pandemic, but its baseline has helped create a number of medical innovations that have created a safer approach to heart surgery and a more effective result from it as well. So I think in some ways the opportunity of healthcare is so aligned with ESG to help improve the lives of human beings, but it's often where the business line intersects with regulation and perhaps accessibility that can get challenging. And just given the space that we tend to focus on, we don't come across as many of those risks. But that's something that we keep in the back of our mind, not only accessibility of some of these services, but also the operations, just considering the amount of energy and resources necessary to power a lot of healthcare operations.
Another question came through, Katherine. I think you slightly just touched on it there, but what are your thoughts on what types of financial disclosures companies should have to better examine SBA?
It's a very timely question. We're seeing a lot of activity from the SEC, from the CFA, from the SFDR out in Europe. I think people are hungry for certification because, again, it is just a space that's boomed over the years. The basic level of disclosure that we need as investors is that which is aligned with long-term financial indicators. So in an ideal world, we find that in the same place that we go for the information we input in our models. So a 10K or our overall earnings calls, that's where we think it's the best placement to represent how aligned ESG is with overall fundamentals. As a minimum, we don't care if it's SASB or TCFD or Paris aligned. We just need to see that it's tied to cost savings or revenue growth. And we need to be able to prove that with data. I think the industry is leaning more and more towards SASB, just speaking frankly. It's bought up a bunch of some of the smaller shops, and there's a lot of money behind it that's backing it. And it's a great framework. So I think we can expect to see more companies reporting using that.
Okay, I think that looks like we've addressed all the questions so far. Is there anything else that you wanted to add there, Rod?
Nothing else I'd like to add, just a compliment to Katherine. Just a great presentation, one of the best we've had this year so far. So gave us a lot of substance, and we certainly appreciate that.
That's generous, and we really appreciate you taking the time on a Friday, no less. So thank you very much, and please reach out to Steph if you have any questions.
All right, we certainly will do that. All right, guys. Well, listen, we appreciate you guys. Again, our objective is to always bring you meaningful content that adds value, and hopefully you were able to get some value out of this presentation today. So you should be able to log on to our website within the next week and view this presentation again, if you so choose to. So until next time, have a wonderful weekend, and thanks again for attending Money Talks. Bye-bye for now.